Hey everybody, we're back with another dose of economic reality. Let's go ahead and get right into it. Most of you have probably heard the news about the Fed decision, and of course the rates are holding steady, but that's not the big story. The big story is the rate cuts that are being forecasted out of the central bank. Let's go right over to CNBC. Now, it's not so much the headline. The Feds they hold the rate steady. That's obvious. And they indicated rate cuts coming in 2024. In fact, several rate cuts. That's not news probably to most of you, and maybe this is the first time you're hearing it. But let's talk about what's behind the reason for the Fed needing to cut rates, right? We're told that everything's fine, right? The consumer is resilient, the economy is super strong. So then we're forecasting rate cuts. What would be the reason? Well, we're going to get into it here, and I think a lot of you will be a little bit surprised at what's headed to us down the road here, what's coming at us here, so to speak. First, please give this video a like. It helps the traction, helps get the video out in front of more people, so more people can see economic reality, see what's happening, right? So let's get right into it here. So rate cuts, the markets loved it. Stock market, all-time high, as I said it would be. I predicted a massive short squeeze, and I don't like to sit here and make predictions because so many things could come in and change as far as the intervention, in these markets, the rate manipulation, you name it. But it was pretty obvious to see, going into 2024, that they don't want to have a stock market correction. In fact, this was the biggest purchase of bonds that I have seen in a long, long time. We had the 10-year bond yield basically crash because so many investors are in there buying. Now, the question is, what investors are buying these, right? Is it central bank backed investors? Is it real investors? Well, a lot of it is, I think, real investors. We don't really know what the central bank's doing. Supposedly, the central bank's unwinding their balance sheet. So we'll have to take that at face value. Their charts tell us that they're shedding assets from their balance sheet, meaning they're selling more than they're buying. And in fact, it went from 9 trillion down to just under 8 trillion now. So again, we'll say that that is correct. Why would investors be so bullish on the market right now? Well, they're predicting more easy money and more rises in stocks, but that's not it. If you think that rates are going to be lower, you'd want to get into the bonds at the current yield before the yields crash even more, right? But the question is, the big question we should all be asking is, why do we need rate cuts if everything is fine? All right, so let's go back in history a little bit here. To me, I don't think this is bullish right now for stocks, but ultimately this is very, very bearish. And let me tell you why. Every other time that we have cut rates, and we're going to go back to a chart here in a bit, every other time we've cut rates, a severe economic recession, downturn, correction, whatever name you want to put on it, a severe economic change happened shortly afterward. Let's go over here to the chart here, straight out of the Fed, and bring it up into a bigger screen here. And I want you to look at the shaded areas. Okay, financial crisis, obviously a very broad shaded area in the chart here. If you're looking at the chart, it's pretty wide there, like an inch wide. Dot-com bubble, 2001, again there. But go down to the blue line and look at every time a rate hike and then a rate cut. But the official recession did not kick in until rates began to be cut. And what have we been forecasting here in this channel? We said about March of next year, we're likely to start seeing, we're going to start seeing, trying to get my words together today. We're going to start seeing rate cuts. Why did I say that? Well, we look back at previous rate hike cycles, and the average between when they raised rates and when they started cutting rates is about 8 months, right? Sometimes longer, sometimes less, but it averaged out to be 8 months. And from the time the last rate hike occurred, we looked at March as the likely probability. And this was before this meeting that just happened on December 13th. This was, months back. We said this was likely. Now, we'll see if that holds true, but it's interesting that we have Jerome Powell out there now basically saying, yes, we need to cut rates. There's going to be 3 rate cuts. Not only are we not going to raise rates even more, but there's going to be rate cuts in 2024. So what do they see coming on the horizon? That's what we should all be asking ourselves, right? Not the fact that it happened. Anybody can read the headline, it happened. But why did they do that? What do they see coming? What's headed at us here down these railroad tracks? This is, to me, a big red flag. Now, the stock market, of course, they're looking at this as a major buying opportunity because good times are here again. Low rates are going to be headed at us again here in 2024. Now, first of all, let's talk about low rates. Right now, the rates aren't even high from a historical perspective. I mean, if you look back here, look at the 1980s, over 18%, close to 20% in the early 80s. Even before the dot-com bust, 99, 2000, we're up over 6%. Before the financial crisis, 5.25%, pretty close to where we're at right now, actually. But the time that it takes for cuts to start happening before they decide that things are really going bad in the economy, it's about 8 months, right? So it could happen before March, could happen a couple months afterward, but as I said before, it's going to happen. And now we've got the Fed basically acknowledging it, right? So things are playing out pretty close. I mean, pretty spot on to what we've, indicated is very likely here to happen. But let's bring this chart back up here. And again, let me bring up the big chart here. So look very closely at the time from when the rates were cut to when they finally admitted or acknowledged that there was a recession. It's not very, very long. Let's see here. They cut the rate. This is 2007. They cut the rate in September 2007. The recession didn't get officially acknowledged until early to mid 2008, pretty early 2008, let's say March. I'm just going off of the chart here as close as I can read it. Pretty close, right? So a few months, folks, and I think some big things are going to be happening. All right. Now I have said here, prepare for both scenarios. Just because it's happened just about every time in the past doesn't guarantee that it's going to happen the same way in the future. And I think there's a line out there about that. Past performance is not indicative of future results. I think that's kind of the investing thing that people have to say when they're putting out information about any sort of investment or economic guidelines or economic, what's the word I'm looking for? Advice. None of this should be taken as advice. Do your own due diligence. Everyone has their own unique financial situation, right? So I'm not here to give anybody advice. But look what's happened just about every time in the past. We have this time in the mid-90s where they raised rates and they kept them elevated for a long time, raised them some more, and that's when we saw the dot-com bust. Or was it the bust that created the need to cut rates? Again, so what is going to be the need? What's going to happen to where we're going to have to cut rates in 2024? Well, if you looked at the speech, if you listen to the speech rather, out of Jerome Powell and crew, you wouldn't have known anything directly. They didn't make it obvious. They used a lot of vague, general terms. And again, this is someone that's reading off of a script. If you watch him, he's looking down at the paper. So he has his answers to these questions pre-written, right? So that should tell you, how much of a show this all is. They know what's happening, and we're talking about Jerome Powell. Everyone there knows what's going to be happening, just like you and I know. They're just not going to say it, and we have to cover this because people still get confused on this. Why can't they say it? Well, that would be bringing on the downturn much faster. Have you ever seen, before any economic recession, downturn, correction, have you ever seen the Fed coming out there saying, warning, warning, these debt levels are unsustainable, defaults are increasing, there's likely going to be a big correction coming at us in the very near future? Have you ever seen that? Of course not. They're not going to go out there and put their foot in their mouth. It would be the truth, though. I shouldn't say put their foot in their mouth. They would be telling they would be being honest, but they can't be honest because that would pull the curtain back on this whole facade that the economy is good. So on one hand, you're not raising rates anymore because you're supposed to be winning the war on inflation. So we're told that they're winning the war on inflation, yet we look at the numbers, and was it the last video or the video before? We look at the numbers each month, inflation ticks higher. Now the rate of increase has slowed, and that's of course what they put the spotlight on. The increase is slowing. The increase is slowing. Hooray, hooray, rah, rah, rah. But in the meantime, prices are still going up. We saw October was the only month in 2023, the whole year. October was the only month where prices didn't tick up from the previous month. Of course, they look at the year-over-year number to give the impression that the cost of living is coming down, but cost of living is actually still going up. It's the rate of inflation that's coming down, right? So very interesting. Like to know what your thoughts are on this. What do you see headed at us here in 2024? And more importantly, what do they see? What does Jerome Powell see or the Fed see coming at us? Because for rates to be cut, something is going to happen to justify that, right? I'll just leave it very vague in this video because I don't think YouTube really liked my, what am I going to say, my forecast. They didn't like my choice of words, I guess, for what I think is going to be happening in 2024. And to put that into perspective, here's what I recommend. Have expenses, emergency expensive cash, food, water, essentials out of the system at your fingertips, readily available at your fingertips, not in a vault somewhere, definitely not in a bank somewhere. I keep some money in the bank, just enough to keep up with the bills and pay bills and stuff like that. 5% yield is nice, but it's a lot easier to make 5% than investing and having that cash ready to invest, in my opinion. But then when you invest, you have to have it on some online platform somewhere, which is also risky, right? But as far as money in the bank, if someone looked at my bank account, they would probably think I'm pretty poor because I hardly keep anything in there. But that's for a reason, and I don't think the bank failures that we saw at the beginning of this year are going to be the last of bank failures. And maybe that's what the Fed sees. Maybe that's the whole reason why they're putting it out there and kind of forecasting 3 rate cuts. Right? It's interesting that they say they're data dependent, but yet they're predicting rate cuts in 2024. So obviously they're seeing something on the horizon that's more than just waiting for the data to come out, because of course none of the data is out for 2024. So on one hand they say they're data dependent, but on the other hand, we just saw the meeting and they say there's going to have to be rate cuts, right? So pretty interesting, right? Well, let's get into some other news here. Still on topic or on the subject of the financial situation here, financial crisis 2.0, economic correction, Great Depression 2.0, some people are calling it. But let's go back to stocks for a minute here. Wall Street traders go all in on great monetary pivot of 2024. That's the way Bloomberg is putting it. So easy money, good news, right? Lower rates, good news. We can borrow money at rock bottom rates again and make money in the markets, right? That's how traders are viewing this. But why are they not asking the question, what's the reason for the rate cuts? What's happening or what's going to happen that's going to justify these rate cuts? Why aren't investors looking at that? To me, this is more of a red flag. Now, it doesn't mean you can't make money. Obviously, there's going to be a huge short squeeze again here because the shorts, people were betting on the market dropping. They're going to have to cover their positions. That means they have to buy back the shares that they borrowed. Just how short selling works, and that's inflationary for the stock market. That's upward pressure on prices when you have to buy to cover your short position. On top of that, we have investors going all in, it looks like, on these markets. So very interesting. You can make money in this environment, but what I'm saying is think about the reason behind all this. It's not good. If you have to cut rates, it's not good. This goes all the way back to when they first started raising rates. We said it right here on this channel many times. If you want to raise rates, if you want to fight the high cost of living / inflation, why do we have tiny fractions of rate hikes, right? 0.25%. Why? If you want to fight inflation in a higher rates are the solution, go all in. Just raise rates to 5% and then 10%, and then the next meeting 15%. See what I'm saying here? So they didn't want to shock all of the debt. Let me think of a word here. They didn't want to cause basically a debt tsunami, right? They wanted to give time people to adjust to this. Give the markets time to adjust to these raising rates and now falling rates. And we'll see how fast they drop them. It's going to be interesting, though. Will they drop them a lot faster than they increase them, right? So we saw what the biggest increase was still less than 1% throughout 2022 and 2023. When they start cutting rates, how much of an emergency is it going to be? Is it going to be an emergency where we have 1%, 1.5% cuts because, something really, really big happened, like another string of bank failures, right? What's it going to be? Nobody knows, but I want you to be ready for it. Now, here's something else that Jerome Powell said. He said that there's basically two different views or two different actions. We have the rate cuts likely in 2024 is what he said, but quantitative tightening will continue is what he said. So basically they're going to continue to shed assets from their balance sheet. That means they're not going to be the buyers of the debt, basically, of the bonds. So very interesting. So they're going to continue quantitative tightening, but see, that's something else that's always changed, or where we always have seen a pivot here. And let's bring up a chart here. Every time we've seen a pivot as far as what the Fed's doing with their balance sheet here. Where did it go? Where did it go? People, take a look at this one right here and look to where the cursor is. And you see the last time the balance sheet was unwinding, also known as quantitative tightening, didn't last very long. So what did we go to back then? We were just over 4.4 trillion. They did the unwinding down to about 3.85 trillion, a little bit under that, 3.7 trillion. Not exact, but you get the point. It wasn't a very big unwinding before, boom, what do we see? The Fed buying everything under the sun. So now we went from just over 9 trillion down to just under 8 trillion, about 7.7, give or take. So already a pretty good unwinding has happened so far, already bigger than what we saw before the financial crisis. And so really, again, should be no surprise that rate cuts are in the cards, because quantitative tightening doesn't last long either, just like higher or elevated interest rates. And again, not really high from a historical perspective, but compared to the last 10, 15 years, the 5.25 funds rate that we've been sitting at for a while now is actually high. Interesting, right? So we're going to watch 2024 together, folks. It's going to be fun. It might be even scary for some, but if you're well positioned, if you're ready for this, if you know exactly, of course, we know everything that led up to this. We know the reasons behind it. We have economic reality. We're connecting the dots here. So we're ready for it. And I hope, you're ready, and I hope I'm ready. I mean, I think I'm ready. When you think you're ready for something, it always ends up being more difficult. Doesn't it seem like that? I thought I was ready to be a parent. I thought I was going to be a great dad, and I think I am. But as far as the amount of work and time and energy that it's taking, wow, being a parent is, it's way more. I don't want to say difficult. Well, it is difficult. Good days and bad days, but it takes a lot of time. I've got so many projects, that I just put on hold because something else comes up. Oh, this at the school, that at the school, health situations, emergencies, broken arms, not too many of those things, but just an example of some of the things, that have happened that I think if you're a parent that's raised somebody, raised a kid, even one kid is a lot of work. But I wanted to put that into perspective because just like preparing financially or getting ready for a shift in the economy, things usually end up being a lot more difficult just in general than I think what a lot of us anticipate. Now, there are some people out there that have anxiety, and they're always envisioning the worst case scenario. And And I've said, things here on this channel that, definitely sound pretty dire, like food shortages, supply chain disruptions. And before 2020, those things sounded crazy. People, so many bad feedback emails and, name calling. People said I was cuckoo to even be thinking about the possibility of something like that happening in the United States of America. We're the world's richest nation. What are you talking about? Crazy talk is what they said. And then 2020 happened, and people said, "Wow, that was wild. We never thought we'd see everything get shut down. We never thought we would see prices skyrocket like we did. We never thought we would see these financial bubbles, economic bubbles, get inflated and inflation go up and really not come down." However, there are some good numbers out here. Let me go ahead and say this for our next report. Rents. Some big things are happening with rents, and that's an indicator, again, of the strength of the U.S. consumer and the economy. But we've been talking a long time in this video here. We've been going over, 20 minutes. We'll save that for our next report. Big news in rents. Come back to this channel for that. Please, we'll see you again here next time, hopefully tomorrow. Thanks, everybody, for watching. Keep stacking now. Bye.